Hi, I'm Stock Investor Davis. Welcome to the channel and please subscribe. Let's take a look at Supermicro. It's been about a week since we last checked in. For the most part during the week, it looks like it actually went down for the first 3 days of the week, and then towards the end it actually picked up and actually improved about 5%, most of the gains coming on Friday. So what I want to cover is there were a couple articles put out, and I just want to dig into them a little bit and just share my opinion on those. So we have an analyst price target update, valuation analysis, and then a technical analysis. So let's jump into that. Starting off with our price target update, we have in the top left Tigris Financial. They've updated their 1-year price target going from $7.90 to $9.85. I also include in the bottom right the top institutional holders of Supermicro, and when we just skim through that list of 10, we don't see Tigris Financial. So for me, that just means it's not a big improvement, as opposed to if, say, Vanguard, who's number 2 on that list, if they were to propose some price target adjustment of, say, 1,000 plus, I would be more enthusiastic about it. That said, no matter what institution upgrades their target into that 900 plus range, this all bodes well for the company. So this is just another check mark, even if it is one of the smaller companies that doesn't make that top 10 institutional list. So let's look at the valuation analysis. So I pulled up an article that I happened to come across that covers Supermicro, and they make a couple points that I just want to share my perspective on it. And of course, you can let me know what you think in the comments. So starting off, the article goes into it: using a trailing earnings to value a company isn't wise for a quickly changing company, which I've edited to say growing, as Supermicro is doing. Instead, the forward price to earnings ratio is a better choice. When the company entered the year valued at 15 times forward earnings, it was a steal. But at 40 times forward earnings, it no longer holds that designation. So on the chart in the bottom with all the numbers, right around the middle, we have what the company could be looking like at the end of 2024. And we have my numbers off to the right. So it's the first level or the bottom level. So what this author, at least at this point, with a 40 price to earn a forward price to earnings of 40, that's basically estimating that this company is going to do about $22.80 in earnings per share. Now, that compared to what I'm projecting, which is about $27.61, that may be a little bit high. I will have to dig into where I came up with that number. Chances are it was another article similar to this, probably just a different author. But if we now take the average of these two opinions, we come up with $25.21. That seems reasonable, especially the way this company's going. It currently has $12.79. So you're thinking, oh, it's going to double that quickly? Potentially, yes. Next quarter, we're already projecting that it'll get closer to $16.50, possibly higher. So this does seem to be a reasonable range. Then the article continues on, so now shifting to the right side, but that's only a 1-year view. Management aims to achieve $25 billion a year in recurring revenue. If Supermicro can maintain an 8% profit margin and achieve that $25 billion in revenue, that would give it $2 billion in earnings each year. That would be a hypothetical PE ratio of 24. So now going back to the numbers on the bottom, we're now looking at the top strip. This would be December 31st, 2025. Again, another analyst at some point threw out a possible earnings per share of 45. I didn't make that up. That's just their opinion. With this current article using that 24 hypothetical PE ratio going out 2 years, they're more or less saying that they're projecting earnings per share to be $38 based on the current price. And again, this article was published just yesterday, so the price should be very much in line. So If we then take the averages, we have that very high analyst thinking $45 earnings per share is possible versus what this current author is saying, maybe about $38 earnings per share. Take that average of that, you're at about $41.50, which gives us a average forward price to earnings of about 22. So again, we're all in the same ballpark. The one change that I'm going to make, and this does seem possibly risky, especially compared to these different analysts, what I'm projecting is, at least right now, Supermicro, they're trading at about 60 price to earnings plus. I think right now, if I look, it's actually around 70. And once we get into the technicals, and if you've seen a previous video, right now, I would say Supermicro is going to trade between about a PE ratio of 60 to 80. So it being at 70, that's right in line with what we're thinking. And so focusing again on that bottom chart with all the numbers, the last two columns is kind of what I'm hoping. This is definitely a very sunny disposition for the company. But what if this company in 1 year, they continue to show growth and maybe it slows down, that's kind of expected, but what if they just continue along and within a year, they're still able to ask and receive a multiple of between 60 and 80. So just taking the low end, that's 60, within 1 year, that could mean a potential price point of about $1,500. So again, very sunny here. And then if we actually take it out another year, so now 2 years in advance, where they're saying that forward PE ratio of about 22 versus, 24, somewhere in that range. Well, what if the company is still growing at a good enough pace to ask and get a forward price to earnings of 60? That would put it at about 2,500. Again, very sunny disposition, but it doesn't seem too far-fetched to think that the company could do this. And those price points, that 60 price to earnings multiple, I'm taking the average. So it's not I'm taking the lower or the higher. I'm trying to be as fair as possible and take the middle. As more information comes out, I will, update things. But let's continue on with the article. The article then continues on by saying there isn't much difference between Supermicro's products and those offered by Hewlett-Packard or IBM. Supermicro is focused on the server business, which is a pure play investment, unlike the others, which makes it a more popular stock pick than the other two, which are bogged down by legacy businesses. So let's just look at the numbers. Let's see how they all kind of compare. So the first chart up top, we have Supermicro, Hewlett-Packard, and IBM. I even threw in Dell because I figured that's still in the same ballpark too. So if we look at the first three columns, that shows their margins and how they compare. Supermicro is at the top. The biggest factor is that net income percentage. So the third column in, Supermicro is at 8%. It's actually above Hewlett-Packard. It's above Dell. A little bit below IBM, but they're all in the same ballpark. Operating margin, that would be the next step up. Again, all in the same ballpark. We see Supermicro at 9, which matches Hewlett-Packard. Dell's at 5, IBM's at 15. And then the biggest kind of concern with them is the gross margins. But again, the fact that their operating expenses and their other expenses are held within reason, what we most care about is that net income. But again, gross margins, that is the weakest spot for this company right now, is Supermicro's at 16%, when Hewlett-Packard, 35%, Dell's at 23%, and IBM's at 55%. So yes, that can be viewed as a negative, but if this article's saying they're the same potentially as Hewlett-Packard and IBM, that kind of tells me there's potential here, that if Supermicro could actually improve their gross margins, and if they can keep their operating and other expenses, within reason, relatively flat over time, this actually could be better than those companies. Next, I want to point out that green highlighted figure showing Supermicro's shares outstanding, which is 57, meaning 57 million shares. So all those figures in that column are in millions. And so we look at Hewlett-Packard, about 1.3 billion shares outstanding, Dell, over 700 million shares outstanding, and IBM, over 900 million shares outstanding. So when you look at those numbers, you would think Supermicro, clearly they're just in the infant stage. Clearly, right? I mean, the next closest company is more than 10 times larger in terms of share count. But if we now actually skip ahead just for a second to the bottom chart, if we look at that column highlighted green in the closer to the left, it's just the headers highlighted in green, the revenue for 2023. Once again, all those are in millions. We see Supermicro making about $7.1 billion compared to, we'll just look at Hewlett-Packard next on the list. They make $29 billion. So Hewlett-Packard, arguably, you could say in terms of revenue, is about 4 times larger. But when we look at the share count, I mean, it's 10, almost 20 times larger in terms of shares. If we look at Dell, that's actually kind of the best comparison of the bunch, and that's the one that I added, where Dell has that 700 million shares, which is, it's more than 10, but somewhere around, I would say, about 12 times larger in terms of shares. Dell's revenue compared to Supermicro, that actually is kind of close, about a 12 times larger comparison. But then the other company that the article mentions, IBM, the share count going from Supermicro's 60 up to IBM's 900 plus, we're talking 15 times as many shares. But when we look at the revenue going from 7 to 61, that is less than 10 times. So just kind of give you an idea of how valuable a share of this company is to another company. Just a reason why I kind of like it. The last point, covering that top box, we have the revenue per share and the earnings per share. This is kind of the last point that really emphasizes why Supermicro can get the multiple that they're getting compared to these comparables. If we look at the revenue per share, Supermicro makes $163, almost $164 per share, and their earnings per share is almost $13. When we look at a Hewlett-Packard, who makes $22 per share, again, realizing that that's due to that share count, another reason why having a lower one makes it look better. It shows their earnings in a better light, it shows the revenue per share in a better light, because here we have now Hewlett-Packard, earnings per share $1.54. So Supermicro looks much more profitable. Dell, similar story. They're actually the closest in terms of their revenue per share at $123, but Supermicro 33% higher. Dell also has earnings per share of about $3 to $4 per share. Supermicro makes 3 times that. IBM, revenue per share, they're in that 60 to 70 revenue per share range. Earnings per share, they're actually the highest at 8. Still, Supermicro 50% higher than the closest company. Continuing on with that bottom track, that bottom graphic. So one of the reasons why I don't want to compare Supermicro to these other companies, even though they're in the same business, even though they're having very similar margins, the reason Supermicro gets this type of multiple is because of its growth. So it's a little bit jumbled, I guess, the information, but it's color coded. So the yellow, that's 2022, the green is 2023, and then we have the pink, which is 2024. So if we just look at, let's look at 2022's information. Supermicro grew 46% in revenue. Let's compare that to Hewlett-Packard, 2.6% growth. Dell, 1.1% growth. IBM 5.5% growth. All of them less than 6%. Supermicro 46%. Then we go to this current year, 2023. What did Supermicro do? Put up 37% growth compared to Hewlett Packard, 2%. Dell actually went down close to 11%, and IBM also did about 2%. So again, Supermicro is growing 10 times faster, more than that, than these other companies. And now let's look into the future. What are these companies guiding for? And not just what are they guiding for, but what are the analysts projecting? And the reason I mention that is because analysts normally will actually guess higher. In most cases, normally if a company, NVIDIA is kind of a recent one where they're projecting something like $22 billion in revenue next quarter, but the analysts, they're already saying, we actually want 23. So this is the analyst guide, which might be a little bit higher than the actual company's guidance. But here we have Supermicro. Again, they're now projecting 103% growth in revenue compared to Hewlett Packard, 1%, Dell, 1%, IBM, 3%. This is not apples to apples here. Yes, they're in the same industry. Yes, they're manufacturing similar products, but Supermicro is growing so fast, they just deserve this type of multiple at this point. I also want to add that, again, if we look at 2024, that pink column, not the percentages, which is on the far right, but the second to far right, we can see the revenue comparison between these companies. So Supermicro, they're projecting to do 14.5 billion, Hewlett Packard 29 to 30 billion, Dell 92 billion, and IBM 63 to 64 billion. So why am I pointing that out? Because again, this article is saying they are the same essentially as Hewlett Packard, IBM, and I'm throwing in Dell because I feel like they're all in the same category. But this, again, now shows another reason to me why Supermicro has the potential to continue to run. If they're literally going to be the same as Hewlett Packard, they can easily do 30 billion in revenue. If they're going to be the same as an IBM, they could do 63 to 64 billion in revenue. So why would it stop, say, at next year, 25 billion? If NVIDIA is going to keep ramping up, which is a big kind of contributor to Supermicro's current success, if NVIDIA is going to keep growing, Supermicro is going to keep growing. And these comparisons kind of show me that there's still a lot of potential for this company. So we'll see how it all plays out, but let's now pivot to the technical analysis just to see how we're looking. Now, switching to the technical analysis. So this past week, again, Supermicro's making progress here, closing off the week at 905, starting the week at around, it looks like 860, and I guess in the after hours, it kind of popped up to maybe 880 to actually start the week. But again, overall, green candle, we like to see that. It looks like it's following this uptrend that we have painted in here, going towards its next earnings call. So again, the way I'm treating this, and of course I'm going to be as flexible as possible, whenever I'm looking at this, right now for this whole quarter, 770 seems like it can be the bottom. If it were to break our projected uptrend forecast that we have here, yeah, I could see it easily dropping down to a 770. Will it? I don't know, but right now I would say there's two scenarios that could play out. The more optimistic one is as it kind of gets closer to its next earnings, it's already guided that it's going to do achieve such and such results. With those results and keeping that 60 to 80 price to earnings ratio, this will be the range that I expect it to be in during its next quarter, which would be about from end of April through end of July. So in that 3-month range, this is kind of where I expect it to be, between about 990 up to about 13 70, somewhere in that range. So the optimistic viewpoint would be, as it moves towards that range going into next quarter, I would imagine it'll just slowly kind of chop upwards until we get into this range. Maybe it'll chop upwards towards the bottom of that guidance, all the way up to the top. Not sure. The other scenario, a more, I guess, a conservative viewpoint would be, it could just trade in between these boxes that I have here. This green box being the current quarter's PE ratio of 60, and this red box up here of that 80. It could just hang out in this range, consolidate for the next, say, 2 months, and I wouldn't be surprised either. But again, I'm just trying to showcase 2 different ways that it could act. Right now, the way I'm looking at it is, if it breaks into this triangle down here where it gets closer to the current PE ratio of 60, knowing that the current PE ratio next quarter of 60 is going to be a lot higher than it currently is. If it dips in this triangle area down here, that seems like it's going to be a buying opportunity for me. Alternatively, if it were to accelerate out here, probably a better time to take profits, but right now we're more towards the green side, so that's what we're playing with. But overall, it does seem like it's following that uptrend projection that we have here, and we'll just, play it week by week, see how this plays out, and that kind of wraps this up. Let me know what your thoughts are. I hope you enjoyed this. I hope you just kind of see another different opinion on this, but that's it. I hope you enjoyed, and remember to subscribe. See ya.